Welcome back, everybody. Today we're talking about depreciation of your rental properties and how that is supposed to be handled. It is an area that I see done incorrectly almost every time I get a new client who has a rental property. So we're going to go over some of the things that you need to know when you're depreciating a rental property. Now, the first thing you need to know is that you are not depreciating the rental property from the full price of the property. Okay, so you may have purchased a property for $200,000, but that's not going to be your starting point for depreciation because land is not depreciable. So you have to take that $200,000 and you have to split it by land value and then by the improvements value. Now, improvements is a fancy way of talking about all the things that you do to a property to make it usable. So we're talking about infrastructure, we're talking about buildings, we're talking about the things connected to those items. Now, a lot of people are like, well, how do I know how much the land is worth? Well, what I do is I go look at the public records and I find out what the tax assessment of the land is. So let's say in this case, of the $200,000, the land is worth $50,000, and then I depreciate the $150,000. There are a couple of different techniques. That's the one I use. It seems to be the most simple and easy to follow. Now, the other thing that you need to know is that your improvements are depreciated over different periods of time, depending on whether you have a commercial property or a residential property. Commercial property improvements are depreciated over 39 years, and residential are depreciated over 27 and a half years. And they can be very picky too about what can and cannot be depreciated over that period of time. For example, if you buy a water heater, which may be only $400, that is considered an attachment and improvement to the building. So that is actually depreciated over either the 39 or the 27 and a half years. However, if you put new carpet in, not considered depreciable over that period of time, or even new appliances. If you purchase new appliances for your property, those appliances are depreciated over 5 years, not the entire period of time you own the property. So that's something you need to be looking into. Definitely be asking your CPAs or your tax preparers about what is depreciable over 27 or 39 years and whether or not it's depreciable at all. Now, the appliances can be subject to something called Section 179, which is a little rule that the government has allowed that allows businesses to depreciate certain items in the year that they are purchased in full. However, make sure you're talking to your CPA about that and make sure that you qualify for that Section 179. Again, this is going to be a short video. Things like this constantly done incorrectly. And again, the overall reaching message here is talk to your CPA. Everybody have a great day and feel free to contact me if you have any questions. I'm more than happy to give you a call. All my contact information is coming right up. Take care.